Ever get that feeling? You're trying to figure out if a company's a good investment, and it's like your brain hits a wall of numbers.
Oh, yeah. Like staring at some ancient scroll you can't decipher.
Exactly. Okay, let's break this down. Because today, on the deep dive, we're aiming to make that whole process, well, a lot clearer.
Absolutely. We've been looking at some, straightforward ways to approach stock selection, especially if you're newer to investing, or maybe you just want a more efficient way to get a handle on a company.
Yeah, like a shortcut.
Think of it like that.
Yeah.
A shortcut to seeing how fundamentally healthy a company is without getting totally buried in financial data.
Right. Our goal today is pretty simple, really. We want to give you a practical method, something you can actually use to quickly check out potential investments. No finance degree needed.
Mm-hmm.
We're diving into some, let's call it beginner-friendly fundamental analysis, focusing on just a few key financial numbers.
That's the plan.
And by the end, you should hopefully have a much better feel for how to quickly spot the difference between, say, a potentially strong stock and one that, well, might be a bit more risky. We'll use real examples too, make it stick.
And guiding us through this simplified approach are what we're calling the North Star fundamentals, just 3 key things to look at.
Okay.
But together, they can give you a surprisingly clear snapshot of a company's basic quality. We're talking revenue growth, profitability, and debt level.
Revenue growth, profitability, debt level.
Yeah.
Got it. And these aren't just random stats pulled out of thin air, right?
Not at all. We're going to show you exactly why these 3 are so crucial for getting that quick but, insightful view into how a company's actually doing.
Okay, let's do it. First North Star then, revenue growth. What exactly is that telling us?
So in simple terms, revenue growth is just how much more money a company is making from its sales over a period of time. Revenue itself is the total income from selling their stuff, whatever that is.
Okay, the top line.
Exactly, the top line. And what's really interesting, what you're looking for, is consistent growth that often signals a business that's, well, expanding.
Which makes sense. More customers, or maybe existing customers buying more.
Precisely. It suggests there's sustained demand for what they offer, and that's kind of the lifeblood for any investment, wouldn't you say?
Yeah, it definitely feels like a fundamental sign of health
This,
people actually want.
but hang on, could consistent revenue growth ever not be a good sign? Is it always positive?
That's a really sharp question.
Hmm.
Yes, sometimes it might be misleading on its own. For instance, maybe a company's slashing prices like crazy just to boost those sales figures.
Ah, okay. So revenue goes up, but maybe profits go down.
Exactly. Or they might be pushing into new markets with really high startup costs that haven't paid off yet.
Mhm.
But yeah, growth is generally good, but you got to look at it with the other pieces.
Context matters.
Always. But a great example of healthy growth, look at Apple. Their revenue went from, around $229 billion back in 2017 up to about $394 billion in 2024.
Yeah, that works out to roughly like an 8% increase every year for 5 years straight.
That's pretty solid growth year after year. Shows people keep wanting their iPhones and services and everything else. They're not just a one-hit wonder.
Precisely. It really speaks to their ability to innovate, stay relevant, keep those customers engaged. Now, flip side, what if a company's revenue is flat or even shrinking?
Yeah, that would definitely ring some alarm bells for me. Makes you wonder if they're losing their touch. Maybe the products aren't hitting the mark anymore, or competition's eating their lunch. Sounds like trouble.
That's the basic idea. So for you, the listener, when you're doing that quick check, seeing if sales are consistently going up is a really good first screen. Usually points things in the right direction.
Okay, step 1, look for growing sales.
Huh?
Got it. What's our second North Star? Profitability.
Profitability, exactly. This is all about whether the company is actually making money at the end of the day, after all the costs and expenses are paid.
Right. It's not just about how much cash comes in the door, but how much is left over. And ideally, that leftover bit is growing too.
You nailed it. I mean, a company can have huge sales numbers, billions even, but if they're spending even more to get those sales, well, that's just not sustainable, is it?
Yeah, that sounds like a leaky bucket.
Pretty much. Profitability tells us if their basic business model works. Are they efficient? One simple way to check is their net income. That's the bottom line profit after everything.
Net income. Okay. And you mentioned profit margin too.
Yeah, net profit margin. That's also really helpful.
How so? Why look at the margin?
Okay, so the net profit margin, you calculate it by taking the net income and dividing it by the revenue. It gives you a percentage. And that percentage tells you how much profit the company actually keeps for every single dollar of sales it makes. So say a 20% profit margin means for every dollar that comes in, they hang on to 20 cents as pure profit.
Ah, okay, so it's a measure of efficiency, really, how
Uh-huh.
good they are at converting sales into actual profit.
Exactly. Or maybe it shows they have strong pricing power, they can charge more. Generally, a higher margin is better.
Makes sense.
Think about Apple again. Their net profit margin is often north of 20%. And in recent years, their net income, that bottom line profit, was around $95 billion. dollars.
95 billion. Wow.
Yeah. So putting that margin into perspective, for every $1 they sold, they kept over 20 cents as profit. That's really strong.
Seriously strong. Okay, so what are the red flags then? What does it look like when a company's not doing well here?
Well, the most obvious red flag is a negative profit margin. That means they're actually losing money, spending more than they earn.
Right, operating at a loss.
Or you might see really, really thin margins. Like maybe they're only making a penny or two of profit on each dollar of sales. That suggests they're just barely scraping by, maybe very vulnerable to cost increases or price competition.
Not much wiggle room.
Not much at all. So the key takeaway for new: look for companies that are consistently profitable, ideally with healthy, stable, or even growing margins.
Got it. Okay, so first, rising sales. Second,
Yeah.
actually making good money from those sales.
Yeah.
Consistent profits. Let's hit the third North Star, debt level. This one always feels a bit heavier.
Yeah, debt can sound intimidating, you're right. And look, it's important to understand that debt itself isn't automatically a bad thing for a company.
Oh.
No, many companies use borrowing strategically. They borrow money to invest in new equipment or research or acquisitions, things that can help them grow faster.
Okay, so it can be a tool.
It can be. The problem comes when a company has too much debt. It becomes a burden, like an anchor dragging them down, especially if their earnings aren't strong enough to comfortably cover the interest payments.
Right, like being house poor but for a company. Lots of assets maybe, but struggling to pay the mortgage or, in this case, the interest.
That's a good analogy. So it's not about having zero debt necessarily. It's about having a reasonable amount relative to, the money the company is actually bringing in.
Okay, reasonable relative to income. How do we gauge that quickly?
Well, there are more technical ratios, like debt to equity, which compares debt to the shareholder's stake. A high ratio there can suggest higher risk. But honestly, for a quick first look, a simpler check is just seeing if the company's total debt seems manageable compared to its annual income or profit.
Any rules of thumb?
A big warning sign, a real red flag, is if a company owes significantly more money in total debt than it makes in revenue in a whole year.
Whoa.
Yeah, think about your personal finances. If your total debts, mortgage, car, everything were way higher than your annual salary, you'd probably feel pretty stressed, right?
Ah, yeah, definitely. That puts it in perspective. So we're looking for companies that aren't drowning in debt. What does a healthy picture look like here?
Let's circle back to Apple one more time. In 2024, they had about $85 billion in long-term debt.
Which sounds like a massive number on its own.
It does, but remember their profit. Nearly $95 billion in just one recent year. Their cash flow is enormous. So that $85 billion in debt, they can easily handle the interest payments. It's very manageable for them. In fact, sometimes their net current debt is negative.
Meaning they have more cash than short-term debt.
Exactly. More cash readily available than what they owe in the near term. That's a position of strength.
Okay, so even large debt numbers aren't scary if the company's earnings are even larger and very stable. What about the struggling companies on this front?
Often, companies that are already struggling financially end up taking on more debt just to keep the lights on, to fund operations because they aren't generating enough cash themselves.
Like borrowing to pay the bill.
Yeah, and that can become a really dangerous downward spiral, makes it even harder to turn things around. So the key takeaway for you: generally favor companies with low or at least demonstrably manageable debt levels. It just gives them more breathing room, more flexibility, less risk.
Okay, this is super helpful. So our three North Stars: look for revenue growth, check for solid profitability, and make sure the debt level is manageable. Now, can we see this in action? Maybe compare a company that ticks these boxes versus one that doesn't.
Absolutely. This is where it gets practical. Let's stick with Apple, which we've seen looks fundamentally pretty strong based on these points, and compare it to, how about BlackBerry, a company that's definitely faced more challenges.
Perfect. Apple versus BlackBerry through these three lenses. Let's recap Apple quickly first.
Okay. Apple, revenue growth, check. Strong, consistent increases between 2017 and 2024, as we discussed, healthy sign.
Profitability.
Big check again. Around 94, $95 billion net income recently. Strong profit margins, often over 20%. Very efficient, very profitable. Gives them tons of cash for R&D, dividends, buybacks, whatever.
And debt level.
Check. Yes, they have debt, but it's clearly manageable given their massive profits and cash flow. Net current debt even negative recently.
Hmm.
Solid financial footing.
Okay, clear picture of strength there. Now, BlackBerry. How do they stack up using the same three checks?
Well, it's a stark contrast. First, revenue growth. It's actually revenue decline.
Oh.
Yeah, their revenue fell sharply. From over $2 billion back in 2016 down to around $656 million in 2023.
Billion down to million.
Yeah.
That's significant shrinkage.
Definitely signifies a lost business, reduced demand. So big red flag on growth.
Okay. What about profitability?
Also a red flag, unfortunately. BlackBerry has been operating at a loss in recent years. They reported a net loss of about $128 million recently. Negative profit margin.
So not just shrinking sales, but actually losing money on the sales they do make.
Correct. Very different picture from Apple's billions in profit. Indicates real financial struggle.
Wow. Okay, two strikes. How about debt level?
Well, BlackBerry's absolute debt number isn't astronomical, maybe around $400 million recently. But
Yeah.
then this is the key. That debt becomes much more concerning when you remember they aren't profitable.
Right. No profits means it's harder to pay the interest, let alone pay back the principal.
Exactly. Unlike Apple, they don't have those huge earnings to easily cover their obligations. So even a smaller debt load can put a real strain on a company that's losing money and has weak cash flow.
Okay, the difference is just incredibly clear when you look at it like that. Apple got growth, huge profits, manageable debt. BlackBerry, shrinking sales, losses, and debt that looks riskier because of the lack of profit.
Precisely. It makes it pretty obvious which one looks fundamentally stronger based just on these three simple metrics.
And you mentioned the source material points out how the stocks performed.
Yeah, it notes that over the last decade or so, Apple stock did exceptionally well, while BlackBerry's, well, it largely declined or went sideways. The market, over time, tends to recognize these fundamental differences.
The real number snapshot you mentioned really drives it home, too. Apple, revenue near $400 billion, net income around $95 billion, sales growing 8% a year, debt manageable.
And BlackBerry. Revenue around $650 million, a net loss of $128 million, sales declining maybe 9% a year, and debt that's worrying given the losses.
Seeing it side by side like that.
Yeah.
Yeah. It really shows how these metrics help you differentiate. Now, this is all great, very useful framework.
Yeah.
But where does someone actually find this stuff? Do I need to become an accountant overnight?
Haha, no, thankfully not. That's the beauty of this approach. You don't need to calculate any of this yourself.
Yeah.
There are tons of great free resources online, websites like Yahoo Finance, Google Finance, maybe FinViz. They all provide this information pretty clearly.
Okay, so I can just punch in a company's name or ticker symbol on Yahoo Finance, and it'll show me their revenue trends, their net income, their debt.
Yep. Usually on the summary page or under a financials or statistics tab, you'll find these key numbers laid out. No need to dig through complicated annual reports yourself, especially for this first quick look.
That is such a relief. Makes it feel much more doable.
Exactly. And our source material even hints we might, in a future deep dive, actually walk through where to click on Yahoo Finance or how to use stock screeners to find companies that meet these criteria.
Well, that would be awesome. But for now, the main takeaway is just remember the big three, right?
That's it. Growing sales, healthy profits, manageable debt.
And the rule of thumb.
Pretty simple. If a company ticks all three boxes consistently, looking pretty solid fundamentally, if it's missing one or two, maybe dig a bit deeper, understand why. If it fails on all three, like declining sales, losses, high debt, be very, very cautious. That's a lot of red flags.
Fantastic. This has been incredibly clarifying, seriously. Taking something that feels complex and boiling it down. Now, the source material also had some interesting food for thought questions, kind of like homework for us listeners.
Yeah, prompts to get you thinking a bit more deeply. They're really good. Let's toss a couple out, for instance. What might it mean if a company's revenue is going up, but its profits are going down?
Ooh, okay. Well, like you mentioned earlier, maybe their costs are rising even faster than sales. Or they're cutting prices so much to get that growth that it's killing their margins.
Good possibilities. It definitely shows growth isn't everything, right?
Right. Here's another they posed. Could a company with flat or even declining revenue ever be a good investment?
That's a tricky one. What do you think?
Maybe. Perhaps if they're in a really stable, mature industry and they're still super profitable and just managing things really efficiently, like a cash cow.
Yeah.
Or maybe they're restructuring, cutting costs, and planning a comeback, even if sales are down temporarily.
Those are exactly the kind of scenarios to consider. It forces you to look beyond just the headline number. How about this one? Highly profitable company, but they just took on a ton of new debt. Good or bad?
My gut says, depends why.
Right.
Are they buying a competitor, building a huge new factory that promises massive future returns? Or are they borrowing because their core business is secretly struggling and they need cash? The why seems critical.
It absolutely is. Context is everything with debt, okay? Related. Two companies, similar revenue, similar profit, but one has way more debt than the other. How does that change things?
Well, assuming everything else is equal, I think I'd feel safer with a lower debt company. Less risk, more financial flexibility if things get tough. Less vulnerable. Seems like the easier choice.
That's generally a very sensible way to look at it. A lower financial risk is usually preferred. One more. How could relying only on past growth trick you?
Oh yeah, the classic past performance is no guarantee of future results. An industry could be changing fast, right? New technology, new competitors. A great history doesn't mean the future's secure. You could miss seeing the iceberg ahead if you only look backwards.
Well said. These questions really push you beyond just the surface numbers, don't they? They emphasize that critical thinking, understanding the why behind the numbers is still really important.
Definitely. So this has been a fantastic deep dive. Just to recap the core message, we focused on those three key fundamentals: revenue growth, are sales increasing?
Yeah.
Profitability, are they actually making money?
Mhm.
And debt level, is their borrowing manageable?
Yeah. And by getting a feel for these three North Stars, you, our listener, are genuinely better equipped now. You've got a practical way to get a quick read on a company's financial health, to cut through some of that noise and complexity.
Yeah, hopefully feeling less overwhelmed and more empowered to assess potential investments.
That's the goal.
And while today was about the what and why of these metrics, we did tease that maybe down the road we'll explore the where, exactly where to find this data easily and how to maybe use it in more advanced ways.
For sure. So maybe a little closing thought, a challenge for you listening.
Yeah.
As you go about your week, look at the companies you interact with every day, the coffee shop, the streaming service, the store you bought your shoes from.
Yeah.
Think about them through this lens: revenue, profit, debt, based just on what